My name is Michael Gayed, publisher of the Lead Lag Report. This hopefully will be a really strong and lively conversation given the insane number of tweets that I put out today, which talk specifically about system testing and how to think about periods when you're in anomalies, which I would argue we're unequivocally in at least the last 6 months. Joining us for the hour is Adam Robinson, who I think a lot of people will find really fascinating given the way that he frames things with his Twitter content. And I think you also have a podcast as well, Adam. But for those who are not familiar with your background, Adam, just talk about who you are, how'd you get involved in markets, and what are you doing now?
Sure. So I went to Wharton undergrad, got a law degree at Oxford, and came to New York thinking I was going to write novels. And I thought, how do I support myself? Because I knew if I went to Wall Street or worked at a law firm, I get caught up in that world. And I thought, I know what I'll do. I'll tutor students. And in the process of tutoring my first student, I figured out a way to beat the SAT. And a couple of years later, I teamed up with a guy, actually about a year later, John Katzman, and we built up the Princeton Review into a national business. And then I got into markets sort of, I guess, around the year 2000. I mean, I'd always been interested in markets, of course, because I went to Wharton as a teenager. But it was around 2000 I met an old partner of Soros, a fellow named Victor Niederhofer, and who was sort of a quant. And so that then it sort of resurrected my interest in markets. And last dozen years or so, I've been advising some of the top hedge fund heads and heads of family offices in the world on all global macro markets. So equities, U.S. sectors, bonds, currencies, commodities, the whole shebang. And so that's how I got into markets. I think they're endlessly fascinating. And I would argue, Michael, and I'm sure you'd agree, I think it's really the toughest discipline because you have to think clearly in a world sort of like mixed martial arts, like of the most incentivized players in the world. You've got to think clearly when everything is on the line. So you've got to control your emotions too. So I think it's incredibly fascinating and no greater performance domain.
And no domain which has as much confusion over whether outcome is due to skill or luck, right? I always go back to that point that when you think about all the different professions somebody can choose to be in, some professions, there's a clear line between your skill, your effort, and then the outcome, where you can draw a direct line to that effort and what comes of that effort. But the reality is, and as somebody who is quant-oriented as you are, there's only so much that we can control, and the outcome is very hard to really identify, right? And in terms of how it plays out. So a couple of things. So I want to go with that for a bit, but first I want you to maybe, for the audience, define the difference between a quant versus someone who is rules-based. And I say that because while you can argue they're one and the same, right? Like I consider myself much more rules-based than quant, right? But talk about that distinction for a bit.
Well, so I'm actually not sure of the distinction. I know it is in my mind, and I would say I'm more rules-based in the sense of having a replicable system. I think most investors do not. Even very sophisticated investors, to your point, have gotten where they've gotten largely because the way they do things, which is not systematic, just happen to line up with the market's idiosyncrasies for 5 or 10 years. And they look...
Or 6 months.
Exactly. There you go. And they look brilliant. You know, it's a lot of the people, well-known names, who made a fortune in The Big Short with the housing collapse have done very badly since then because they kept trying to replicate what they did, not realizing they were, in a sense, lucky. Because a system should work in different kinds of environments, right? It should work to the upside, downside. If you're bullish tech, you should know when to be bearish tech. And I'm not going to name any tech investors here, but there should be times when tech is overvalued. We're going to short the heck out of it right now, instead of just always being a perma bull or a perma bear. And so I think you want to find a method that works for each each individual, right? There's no one system that works. Michael's system is great for Michael and might not be good for Adam, and vice versa.
And it's important also to note that systems will have drawdowns, right? Which I think is something we should tease out because a lot of my day today was spent on Twitter, basically just peeling back the onion a little bit and trying to do a little bit of Socratic method, asking people about how they view what happened this year. And to your point about luck versus a repeatable process, in a 6 months like what we've seen, so many people have been pounding their chest about how they saw bonds falling, but nobody has yet to point to me anything that would suggest that bonds would fall in the way that they fell relative to stocks, right? So let's talk about how do you identify if somebody's going to do a little self-reflection on their own trades and their own approach. What's the best way to identify if that successive number of wins was a streak due to luck, or maybe if a drawdown was also due to luck, in that case, bad luck?
Right. Well, the first is, to evaluate your trades via some benchmark, right? So if Johnny is up 17% this quarter and he's pounding his chest, look how great I am, and yet the market's up, 25%, he's actually underperformed the market. So you need some kind of benchmark for one. And then to look at what your drawdowns were. And there are all kinds of metrics, a Sortino ratio, Sharpe ratio, that measure the risk that you undertook to achieve the returns you got. So one would be to start to dissect that, again, relative to some benchmark. And the benchmark could be the S&P 500, or let's say you trade energy stocks, then it should be, say, the energy sector as a whole. And so, for example, if one were evaluating a tech ETF, say, you'd want to see whether that ETF outperformed just a broad basket of tech stocks, like XLK, or the ETF that's probably the most liquid tech ETF, or the Qs, right? QQQ, and then see how you did relative to those benchmarks. I think that's super important.
Right. Now, the challenge, of course, there is, to your point, you have to identify the right benchmark. And unfortunately, as you know, everybody always compares everything to the S&P because of the availability heuristic. It's always on TV, home bias, right, from a behavioral perspective. But I think that the challenge, though, when you think about benchmarking is, first of all, you have to find the right benchmark, but also there might be no real benchmarks for what you do. And I understand everyone always has to have something to compare against, but I feel like that maybe gets people stuck on how to think about their own strategies when their strategies may need a very particular type of environment, whereas the benchmark is for a different environment altogether.
So I agree with you completely. Let's just jump in, for example, regarding volatility and risk off in bonds. And, we've been in we've been in a 40-year bull market-ish for bonds. 38, 39, 40 years since Volcker broke the back of inflation back in the early 80s. And since then, interest rates have declined, inflation has declined, and we've been in a secular bull market, secular meaning, multi-decade bull market for bonds. But there was a time when stocks and bonds went down together, when everything was being dumped, right? During the 70s, right? When you had the bear market in the 70s, so 70 to 74. It's lost like 60% or something. And bonds were getting hit then too. And so I agree with you that bonds gets lift when there's risk off, and yet they can both be dumped. And something that's you mentioned, which I thought was so great, Michael, earlier, anomalous period, is it's very rare for stocks and bonds to be dumped together. And right now, everything seems to be dumped, right? Anything where you can raise cash. So it extends to crypto. I don't know much about the art world and things, but I think that the watchword right now is raise cash. And so stocks are getting sold down, bonds are getting sold down. By the way, this is very interesting, and this is an anomaly. The only thing getting dumped faster than treasuries is investment grade bonds.
Ah, okay. Thank you. Please keep going with that. No, because this is why I keep going back and retweeting with comments and all this stuff all day. It's like people saying they saw the bond market sell off coming. Well, it's like, hold on, what credit quality, what duration, right?
Mm-hmm.
Bonds are not. It's not like a monolithic type of situation. Yes, there's obviously a coupon income component to it, but you have to distinguish by credit quality, and you have to
Right.
distinguish in terms of default risk, which is why treasuries are unique in terms of how they behave in high
Yes.
volatility equity periods. So let's go with that.
Yeah. So I know you always, Mike. I think one of the great things about the lead lag report, you're always educating your followers and subscribers, and so with that in mind, one of my favorite leading risk correlates is the credit spread, and so if you want to track investment grade bonds versus treasuries, it's long LQD, short IEF. So IEF is the ETF for treasuries. And if you do a ratio of those two, you will see that it leads the broad market at every major turning point for the last, I don't know, 17 years. It's never lagged once.
And that's because spreads are contracting because triple B, which has credit risk, is outperforming the risk-free treasury of a rough similar duration.
Well, that's true when it is contracting, but
Right,
now it's
correct.
expanding, right? And so LQDIF is, I think, last time I looked a couple of days ago, was at 21-month extremes. So that means that that's projecting that the S&P. Wait, again, you and I are not giving investment advice. This is just by way of education, a way to look at the market. Is the credit spread suggests the S&P should be at 21-month lows, and yeah, treasuries are getting dumped. Everyone's dumping treasuries, but they're dumping corporate bonds faster, which is not a good sign for the market. It'd be one thing if interest rates were rising of 10 years, right? Treasuries. But corporate bonds, the environment were growing. If the economic environment were good, we'd expect investment grade bonds to be outperforming treasuries, and they're massively underperforming.
Right, and that's only been in the last, let's call it month and a half, because I think the initial phase of this bond sell-off was really more on duration, right? And this
Well,
also,
yeah.
go ahead.
No, I was just going to say, I'm just going to now go to the chart and see. So LQD IEF, so that peaked. Oh, that's interesting. So
It was March, right? March is when it started rallying back, and right.
well, okay, yes. Yeah. So it started rallying back. So I'll tell you when it peaked though. Multi-year peak was early November last year. It peaked and was headed lower. So it peaked a couple months before the S&P 500. The rally you're talking about, which was quite right, Putin invaded Ukraine on February 24th. And from Feb 24th till March 7th, key date, March 7th. And we're going to get to more anomalies in a second here. So from February 24th, again, Putin invades Ukraine. Everyone thought, oh my God, the sky's going to fall. So from Feb 24th to March 7th, there's a massive sell-off in the S&P and all risk assets and a buying of treasuries. And then on March 7th, things started to reverse. And by the way, I don't know, again, speaking about anomalies, the US dollar is at 19-year highs, but it's the second strongest currency in the world right now. The strongest currency is the ruble. The ruble against the dollar is at 7-year highs. And that's extraordinary. And by the way, since March 7th, since the invasion of Ukraine, the number one global performing market, Russian equities.
No, and I'm glad you say, because it's not just, it's, and I've used that line before, it's almost like you have black swans everywhere. We can argue for far about the definition of black swan. I think Taleb, when he responded to my tweet, was missing my point about the sequence of returns factually being a tail event, as opposed to the idea of bonds and stocks going down. It's about this, and as a systems developer, you yourself, know it's really about the path, not the endpoints, right?
Yes,
just like in the 70s,
indeed.
right? So in the 70s, everyone who uses the comparison of the 70s without actually looking deeper, they say, okay, in the 70s, stocks and bonds both did poorly. Again, which bonds is the question. But more importantly, it's in those high volatility thrusts which coincide with equity drawdowns where treasuries actually still acted. And that's the whole point of that data I've been showing all day, still acted as the risk-off safe haven.
Sorry, Michael, you're exactly right. I wanted to jump in and totally agree with everything you just said. So treasuries are the safe haven relative to investment grade bonds. So treasuries have been rising relative to investment grade bonds. Again, you always need the benchmark, right? And the benchmark here for bonds would be treasuries. And treasuries have been rising relative to investment grade bonds. And that's actually risk off, right? That's a sign of risk off. So again, bonds are going down on an absolute basis, but they're going up relative to investment grade bonds. Right? Treasuries are going up relative to investment grade bonds.
Right, and that's an important distinction, that relative convexity, right,
Yes.
against risk assets, right, which is you can equate it to a sort of a black swan type of strategy without the bleed of an options overlay. But that's the whole idea of playing treasuries when you're in these high volatility periods, because you get these very sudden and aggressive relative moves against equities. Now, the data that I showed, and that goes back to 1961. Why 1961? Because you cannot get total return data before that on treasuries, because you never had not only the accurate data as far as the pricing mechanism, but there have been times in the past where the U.S. government suspended doing treasuries. So you can't get continuous data. That's why CRISP, right, goes to 1961. So it's like all these comments that look at yields before this, they're not understanding what's the sequence of yields and how frequently were they updated prior to 1961 to then determine the total return. That's an important distinction. But where I'm going with that is that if we go with this idea that treasuries act as the safe haven and that it's about relative behavior, there are two other times in history where treasuries lost money while stocks were losing money at the same time, but it was like down 1 or 2%. What's happened in this drawdown for equities, as I've noted, and it's in the shared space here, first time ever in history where the drawdown in treasuries is pretty much like the drawdown in equities. Now, that to me sounds like a black swan. Nobody saw it coming in terms of the sequence. It's a tail event, and it is highly consequential. Why is it highly consequential, which is part of the definition of a black swan? Well, it's highly consequential because the Fed can't do anything about it.
Right, right. And again, it's so important that again, we're talking about benchmarks and relative performance is the four best performing sectors year to date on a relative basis are energy stocks, even though they've come back a bit. They're still up relative to the broad market. But utilities, staples, and healthcare, which are defensive sectors. So those sectors, again, energies, utilities, consumer staples, and healthcare, have been outperforming the broad market. So they're up relative to the broad market. And the way to think about this, I don't know if anyone's ever been to Orlando, Florida. There's a ride, the Tower of Terror. Have you ever been on that, Michael? You've ever been on the Tower of Terror?
I gotta it scares the piss out of me.
Yeah.
That's why I refuse to do it.
So,
yeah.
It scared me too. So for those of you who don't know, you are plunged faster than gravity. So you fall faster than a stone. That's really scary. But here's a cool thing you can do. You didn't hear me say this, but imagine you had a quarter on your knee when the ride started. You're plunged faster than gravity, and you see the quarter rise up magically. It's falling. It's just not falling as fast as you are. And so there, in the market, there are all kinds of plays where you go long one thing and short something else. So two things can be falling. For example, utility stocks have fallen. They just haven't fallen as much as the broad market. So relative to the broad market, utility stocks are up, which is another anomaly. Utility stocks usually get slammed when bond yields are rising.
Yeah, no. Let's go with that, because this is also part of my frustration, because the very first paper that I published in 2014 that won the 2014 Dow Award is called an intermarket approach to beta rotation. Goes back to 1926, and the finding is very simple. When utilities, which are the most bond-like sector of the stock market, are outperforming on a short-term basis, that tends to precede higher volatility states, crashes, corrections, bear markets. No different than weakness in lumber to gold, right? Just in a different kind of path. And to your point, utilities benefit from lower rates because they're highly levered. Their earnings variability is much more driven based on the cost of capital than increased revenue, right? Because they're regulated. So that's another one of these anomalies, which again is very, very underappreciated.
So see now this is it's so interesting because if here's a chart to look at, utilities relative to the 10-year. So the ETFs are XLU and IEF, and utilities relative to treasuries are up year to date. So XLU, IEF, let me just see year to date. I'm looking at my chart as we speak here. They're up 6.5%. On a relative basis, actually like double that, like 13%. So utilities have outperformed treasuries by 13% year to date. It's pretty good. So it's interesting. It's so funny you would do that report, and it sounds so seminal that you go back that far. This is such an anomalous period here, because I did the same study not as far back as you did. I stopped at 40 years, and we've never seen utilities outperform like this with rising yields ever. Not to this extent. It's extraordinary.
So this is maybe a good transition to a question around system development and process, because I always go back to this point that every strategy has three components, right? One is whatever signal you're looking at, utilities, lumber to gold, moving average, whatever it is. One is signal. Two is opportunity set, how you're expressing, right? And then three is the look back period, right? Okay. Now, to your point, if your expression of risk off this year was utilities, you would have been way better off than having treasuries as the risk off expression. Even though historically in major drawdowns, treasuries tend to be far better than utilities, because exactly to your point, utilities on a relative basis will outperform, but they're still equities. So they're still going to have that beta on the drawdown.
Yes. So this brings me to one of my key sort of heuristics, key themes that I've been hammering on publicly, actually, since 2017. I was on Tim Ferriss's podcast. I talked about the notion of things that don't make sense. And it's so important in financial markets, and to everything that you just said, Michael, is because when you look at something, whether it's Michael looking at something, or Adam's looking at something, or anybody's looking at something, and you're going, this doesn't make any sense. The market's going down. Why the heck are utilities going up relative to treasuries? Right? That doesn't make sense. And really what that means is that my model of the world isn't making sense, right? Because I've got a model that looked back over the last 50 years, and this always happens, but it's not happening now. And whenever that happens, whenever something, I'm using air quotes, doesn't make sense, it's always a really powerful trend. Very, very, very powerful. Never fight it, because it means that there's something that Adam hasn't thought of and Michael hasn't thought of that's powering this move in utilities. And don't fight it. It could be even intraday. Doesn't matter. Whenever you look at a screen, go, that's weird. The whole sector's down. Energy stocks are down, but oil's up 5%. What the heck is going on here? Something very powerful, always with anomalies.
Right, especially when the co-movement is not acting as it was before, even though the causation never really changed, right? I think that's sort of because again, the causation for utilities outperformance is flight to safety, rates fall. That causation fundamentally has not changed with utilities or staples or healthcare as defensive proxies.
As defensive proxies, absolutely. Now, by the way, staples has a double sort of win-win. Well, three wins, actually, if you think about it. One is it's relatively high-yielding sector. Two is it's a safety. And three, because a lot of the staples are food companies, they're an inflation hedge. So that explains the triple tailwinds for staples. And again, I think sort of the watchword, I try to reduce the world, which is so complex, as you know, Michael, down to simple mantra that Adam's Cocoa Puff brain can get his head around. And the watchword right here is cash. Really, cash is king. Conserve cash and spend money only on things you need to spend money on. Now, I'm saying that's what's playing out in the market, right? Think about the sectors that have outperformed year to date. You need oil, you need gas, right? Oil. You need food. That's done very well. You need electric. Con Ed is going to do very well. Healthcare you're going to need. And within financials, insurance companies need insurance. That's outperformed. And so really across the board of sectors, the sectors that have done the best have been those that offer products or services that people must have.
For everybody, this is like a conversation that's really true to, and near and dear to me, because the problem that which I've been saying many times on Twitter is my hell, is that the risk off asset treasuries, which is not deniable. That's the whole point of me showing the data going back to 1961, that in these drawdowns and equities, treasuries factually, in every single instance except this last 6 months, treasuries factually act as the safe haven, even though, by the way, a year from now, they could both be lower. It's in that sequence. It's in that pattern. And all these anomalies that you're talking about are throwing off these historical relations. Now, this becomes, I think, a really important thing for us to discuss, which is if we agree that this is an anomaly, if we take ourselves out of the day-to-day movements of markets and we say to ourselves, what's happening here has never happened and not just never happened in terms of stocks and bonds, but in terms of treasuries against utilities, in terms of these currency fluctuations, these tails that are wagging everywhere. The question then becomes, if you're a systematic trader, if you're rules-based, what do you do about it?
A fascinating question. So I'm going to throw out three concepts here. The first one is just to go back to something I just said, things that don't make sense. So we're seeing an anomaly. Let's say we're 1 month into the anomaly, right? Okay, it's a 1 month anomaly. Okay, maybe that doesn't mean too much. But after 2 months, you go, okay, 2 months of an anomaly, and then 3 months. So at a certain point, we begin to ask, maybe maybe this is a different regime. And because there's no precedent for it, right? No precedent for it. It's hard we can't rely on statistics, right? Because it's never happened before. And so I want to share, again, this is a sort of a heuristic that I use often and I've repeated publicly, is the question, what precisely do I need to see to tell me I'm wrong? And now I'm talking about Adam, right? What do I need to see? So for example, if I say gold is going higher, let's say, I'm using that as a total example out of the thin air, right? So gold is going higher. I might say gold is going higher unless I see interest rates increase by more than 10% in any 1 week period, or unless I see gold miners drop relative to the S&P by more than 5%. In other words, going into a trade, I will specify precisely what I need to see to tell me I'm wrong, and I'm exiting, right? And so I think that's really important, even with systems. And at a certain point, it's so important to follow systems, so important. And then the question becomes, if there's enough of a breakdown, is this a totally new regime? I am sure you remember, Michael, the summer of 2007 when all the quant funds,
August of 07. There's a great paper. What happened? If anybody that's curious, this actually, I'm so glad you mentioned this. You and I are very similar in our thinking. There's a great paper. I forget the author names, but it was What Happened to the Quants in August of 2007.
Mm-hmm.
Right. And correct if I'm wrong on this, Adam, but there was a period. So the uptick rule was removed July 6th of 2007. And maybe that caused something structurally in markets back then. But basically a month later, what ended up happening is a lot of these long short funds were having like multi-standard deviation spread events in their pairs trading, in their stat arm.
Right.
And then, so it was only like for 2 or 3 days, but it was something that like all their VAR models said, okay, you've got to degross, because you had this moment in time where there was an anomaly in these statistical relationships between going long GM, for example, and then short Ford, just as an example. And I remember very well, Adam, and then I want you to just kind of riff on this. I remember very well that the authors noted that these stat arb funds started degrossing at the exact wrong time. Right? Meaning they were actually taking less risk when they should have been taking more because they were in a dislocation. And the author noted that while they did the prudent thing to degross because they were in the anomaly, it was the exact wrong move.
Yeah. And so at a certain point, so those, I don't think many people remember that event, but August 2007, basically every major quant fund was like losing a year's worth of profits in a month, right? and AQR, right? Cliff Asmus's fund, and a number of other major quant funds had really bad summers. And it's interesting that it hit all the funds, and they don't all trade exactly the same, but it goes to the point where there's some anomaly, and it should tell you, uh-oh, this isn't what I'm used to. I better take myself offline, right? I'm not going to name any names, but there's a very famous fellow who writes a lot of books and runs a fund. And in November of 2019, he publishes a blog piece and he says, the world has gone mad and the system is broken. Think about that. The world has gone mad and the system is broken. Really, what the parenthetical there is, the world doesn't make any sense to me, which is to say, it's not behaving the way my models say it ought to behave. I know myself, if I think, say I'm driving down the road, Michael, and everyone is driving erratically, like everyone on the road is driving really fast and swerving as if everyone was on psychedelics, I'm going to pull over to the side of the road because that's a very dangerous environment. You would think someone who writes a blog piece saying the world doesn't make any sense to me, it's gone mad, therefore I am going to cash. You would have sat out the 35% decline in March of 2020. And so when things don't make sense, it's a time, I think, to wonder whether I'm not saying Michael or Adam, right? Is the regime. I gotta think this through here. Because again, when things don't make sense, something very powerful is in play that our models, Adam's model, Michael's model, whoever it is, model isn't accounting for.
But there's a side to this point about the world doesn't make sense and sitting in cash, which is curious in the context of treasuries, which is to say that people always forget, I think, that the decision to go into cash or to stop following a strategy is actually two decisions. It's when you go into cash and then when you deploy the cash, when you stop your strategy and then when you deploy it. And I always go back to that example of Greenspan saying that the Fed needs three models. One model for what to do when the economy is contracting, one model for what to do with the economy expanding, and then the third model has to tell them which model to use.
Yeah.
Right? Because and I really am sincere because I think this is what's so missed in a lot of these conversations around, then just change your strategy or change your opportunity set. That assumes that the environment is not going to revert back to normal, which you don't know except for hindsight and fairness, right?
Right.
But also the other part of this is that now with this treasury sell-off, there is actually a positive spin on this, which is that now actually there's room to make money being risk off.
Wait, are you saying make money on the short side?
No, being risk off, being along treasuries. If your expression of risk off is treasuries, which historically is a better, I would argue, way of playing a highly volatile period. Right now you've got some room. So my point is that the identification that maybe you should change a strategy or sit out a period because nothing makes sense. The problem is by the time you come to that conclusion, it may be time for the turn anyway.
Oh, I see. So let me throw out another proposition, and this is for your those of us, the people listening in, is if you're a trader, is you have a system that you've developed and you find those market conditions and maybe sectors or types of stocks or types of trading horizons that you excel in, and then just stick to those. What is it? Munger calls circle of competence, right? I'm really good trading energy stocks, or I'm really good day trading high beta stocks, right? Whatever it is, and you stick within your domain, and then if the situation is changing, maybe I should stand aside. Now that's more for a trader than someone who's always in a market, say, right? Just you're gonna, as an investor. But there, trading, you'd want to find those environments that you're good at, those situations, and wait for those situations. And if it's not, stand aside. Right? Buffett and Munger say that most of what they do is wait, wait for a good buy opportunity.
Well, they're waiting for the fat pitch, right? That's which is an interesting discussion because the problem is that people are sucked into the idea that you have to have frequency of gains, right? 1 or 2% per month. When in reality, because of tails, because there are black swans, it's more about the magnitude, right? Whenever that fat pitch really comes.
I want to warn people about the dangers of seeking explanations. It's so important because we want to understand the world, right? We do want to understand the world, and yet we never can. We're always more or less mistaken about the world, right? The world is just too darn complex. And yet, so the danger of an explanation, first of all, we'll never know, Nora, Michael, and Adam, and everyone else listening, we'll never know whether Nora's explanation is correct or not, right? There's no way for us to determine that. And at the end of the day, it doesn't actually matter what's causing it. We just know utilities are outperforming. And until we see evidence otherwise, they'll continue to outperform. The danger of an explanation is confirmation bias, right? We get locked onto an explanation like, oh, this is why utilities are outperforming. And then we look for more evidence that we're right. And it's so important. Again, it's anti-confirmation bias. You want to look for evidence that I'm wrong.
Let me hop on that because I love this because further to your point, you're rules-based, you're systems-based, you have a particular strategy and process. The problem with the human desire to always want to have a reason is that it gives you a sense that you should not abide by your system, that you should not follow this or that particular signal at this particular moment because X, Y, Z is the reason for why this is happening. And the moment you do that, then you find excuses with every single time some kind of a signal tells you to do something. So I always make that point. So you got to be careful with sort of the why, because if your systems and rules based, the why doesn't matter. It actually can be worse because it can cause you to override your own approach.
Yes. Yeah. Oh, by the way, you mentioned low vol stocks. Low vol stocks have outperformed high beta stocks, right? And again, you've always got to choose your benchmark. So if you had been long low vol stocks and short high beta stocks, you're doing very well. In fact, that trade is like at 2-year highs right now. You've been long utilities, short the S&P, again, 2-year highs. If you'd been long staples and short the S&P, 2-year highs. Same with healthcare. So you're correct, Nora. It's low vol stocks have outperformed, but they're still going down. But if you had been long those and short the market, this isn't investment advice, but it'd be at 2-year highs right now.
Well, and also it's still some of the taking it a step further. I'm looking at the S&P's sector weightings. It's more than just this idea of defensive sectors. It's really all the least weighted sectors of the S&P are the best performers this year. Materials at 2.6% of the S&P, real estate 2.92%, utilities are 3%, right? So energy 4.35%, consumer staples 6.99%. So while tech is at 26%. And I only mention that because, and this is why it's so tricky when you think about things from a relative perspective. The idea that utilities, for example, might be outperforming because of rebalancing. Well, the problem is that these what they would call active fund managers will really still have an R squared of 99 against the S&P. They might be marginally overweighting utilities by 10 or 20 basis points. It wouldn't fully explain the momentum by any means.
Right. But again, we don't want to explain.
Correct.
Right? Correct. We want to get away from explanations. And explanations are comforting, but they really set you up for a confirmation bias.
Look, you can argue that everything COVID on has been an anomaly. But in the lead up to COVID, the historical relationship of risk off tail indicators still held true. Even lumber to gold. Lumber was weakened relative to gold just before the COVID crash. So there's a lot, and it's I always go back to that line, right? It's just because it's raining doesn't mean no crash. Doesn't mean just because it's sunny doesn't mean it won't. It's always about probabilities. But when you're in the small sample, the challenge is, again, I go back to what do you do when you're in such a weird environment? Do you bet that things normalize? Because, and maybe it's a good direction to go to, Adam, which is that the problem that I have with this idea that this persists is that I don't believe the system can survive if it does. And I know that sounds dramatic, but if you think it through, if 60-40 is dead, if stocks keep correlating to treasuries, you're talking about a double whammy to the government. You're talking about collapsing tax receipts. Luke Roman's been on top of that correctly so,
Mm-hmm.
right? Because now you don't have asset markets going up. Oh, and then by the way, on top of that, now your interest expense is higher, which means zombie companies start going bankrupt because they can't afford that debt when they roll it over. And on top
Mm-hmm.
of that, the deficit for the U.S. government explodes. So I always make this point: say, be careful what you wish for under this idea that it's regime change and that stocks and treasuries keep acting correlated. Because to me, the implications are far worse than anybody's drawdown in their portfolio.
Right. At a certain point, the betting on the end of the world, right? Betting on apocalypse is never a winning bet because the central bankers of the world, in the past anyway, have gotten together and found some way to like prop up the system again. And yet the question is, how long can someone, how long can you was that great John Maynard Keynes quote, the market could stay irrational longer than someone could stay solvent. And so yeah, I think we're in for some. Take a look at the historic capital rotation into the defensive sectors here. So you're absolutely right, Michael. It's risk off. And then the question is, so where is capital going? Right? It's dumping tech stocks, dumping discretionary. Again, I said before, the sectors that have outperformed right now in a risk off environment are those that offer products or services that people need. Insurance within financials, right? So I'm not saying insurance companies are good stocks to invest in, but I am saying insurance companies relative to other financials are outperforming. Staples companies relative to consumer discretionary, uh, are at 27-month highs. Again, long staples companies, so products that you need to buy, food and things for the home, things you absolutely need, versus discretionary stocks, consumer discretionary, like you don't need another pair of sneakers or another dress or whatever. Those companies are getting slammed. So staples relative to discretionary, and actually I'll pull it up right now. I think it's at 25-month highs. RCD, RHS. Yeah, 25-month highs. 27-month highs. Staples relative to discretionary.
And by the way, that happened with the Fed still barely raising rates. And this is why I keep going back to this narrative around consumer spending and inflation. I think the market has gotten way ahead of the Fed. I mean, way, way, way ahead of the Fed in terms of the idea that it's not maybe just peak inflation, but maybe disinflation or a deflation pulse, because that's what the relative movement of the consumer side is actually telling you.
Right, and you see a lot of hand wringing by economists and the pundits and everything. Are we in a recession or not? It doesn't actually matter. It is clear we are in a recession mindset. Right?
Well said. Yep.
Right? The consumer is in a recession mindset, and that's all that matters. Right? And corporations are in recession mindset. So they're going, oh, we better lay off workers, or we better, right, in terms of corporations, look at all the layoffs. And right, it was just a few months ago, they were talking about the great resignation of all the young people, millennials are quitting their jobs. And I don't think people would be so quick to quit right now.
And the roaring 20s and all these stupid narratives that it's just like, we're not that long ago.
Yeah, it's not. Right. So consumers, which is to say households, are in a recession mindset, and corporate CEOs in a recession mindset. And a recession mindset is going to lead to a recession, whether or not we're in one or not. It doesn't actually matter because they're behaving as if we're in a recession, right? And that's affecting, capital expenditures, profits, cash flow, everything. So it doesn't, the economists always late to the party, always get it wrong. So yes, we're in a recession mindset, and it's going to take a while before consumers go, oh, I guess we're not in a recession anymore. I guess things are okay. That's going to take a while to shake off.
Right, especially if housing is still early in its own turn. By the way, on that point about Keynes, markets can remain irrational longer than you can say solvent. I used to always joke that's only true if you're shorting. Right, right, because markets can be irrational. I'd argue, I've shared it at the top, right? I put that tweet out yesterday. Markets can remain irrational longer than you can stay disciplined. I think that's really the proper way to frame it, right? Personally.
Anyone who's confident about this world is not paying attention. Like, you'd be a fool to be confident in this environment. And I'm not saying you should panic, but we're very serious times right now, right? But we have the shock just when we were kind of getting our head around the COVID pandemic. All of a sudden, out of nowhere, Russia invades Ukraine. Huh. And who knows? Again, here's the way to think about the world. We're in a world where we couldn't anticipate COVID. We couldn't anticipate the Ukraine crisis. What else don't we know about the world, right? Where's the next shoe that's going to fall? And so this is very much the way to get ahead is to preserve capital, right? And the trends that are in place are going to stay in place until we see evidence otherwise. We've got to see evidence, not explanations, just evidence that things have changed.
That whole bit is the difference between a rules-based approach and everybody else. Because to your point, the explanation doesn't matter; it's the data and the relationships maintaining, right? That matters. It's like I always make it a point that all I try to do, maybe in a colorful way, is give voice to math, right? Because everything I do is rules-based, mathematically based on relationships, and I'm just a cheerleader. And maybe that's a good way to wrap up. At the very beginning, Adam, you had mentioned this point that this is maybe the toughest discipline because you have to think clearly. And thinking clearly to me seems really difficult in this environment when everybody wants to, pound their chest and say, I got this call right, you didn't, and your approach, which is not working, is broken.
Right. I mean, the thing is, the thing about investing is it's always a matter of the odds, right? And you got to, if you have a system that works, say, 65 or 70% of the time, then 30% of the time it's not going to work. It doesn't mean the system is broken, right? And for example, when the meteorologist says there's a 30% chance of rain, that means if you look back over the last year when he said that or she said that, 30% of the days it rained. But it could have been wrong any number of the times, right? So it's always the long haul. That's what you got to be in it for.
Further to that point, it's like when people would, once it was announced that Trump won, right? Everyone said, oh, there was no way he was going to win, but he still had, according to the bookies, whatever, 5-10%. That's still a percentage, right? There's still a chance. So my point is that I think people confuse low probability with no probability, in anything, in markets, in life in general. And that's the challenge in the small sample to try to wrap your head around. So listen, everybody that's here, we're a little bit over. And Adam was kind enough to join us late tonight. Everybody, please make sure you follow Adam. And as you can tell, very thoughtful. I very much enjoy this conversation because a lot of what Adam spoke about here resonates very highly to me, right? As somebody that, is, the man in the arena with these strategies that's going through our time. And I'm very open about that. And I try to present data as much as I can to try to explain what's happening, not to provide an excuse, but to provide context. I think more and more you need to have people that actually provide the context as opposed to just look to the right of the equal sign, look to the left.
Absolutely.
Thank you, Adam.